Don't know if you had a chance to watch yesterday's lecture. I kind of introduced the stock market a little bit so that you get a little bit better understanding of how the market works. Okay, do any of you guys own stock? Cindy, you do? You know what you own stock in? Okay, Disney? Okay. Yeah. So you have all your eggs in one basket? Just like one stock, sounds like, maybe? Okay. All right. So give me an example of Boeing. You guys all know what Boeing makes, right? They make planes, right? Now, the 737 is probably their most popular brand that they've sold the most of. In recent years, they came out with the 737 MAX. You may have heard about this. 3 of them. 3 crashes. Okay, and so every 737 MAX in the world was grounded. It's been almost a year. Okay, now they had an engineering, software in there. These planes basically fly themselves. Okay, but there was something wrong in the system that were causing the pilots to be confused, and they were losing control of the aircraft. Okay, so they shut them down. Now let's say, like Cindy, you put all your eggs in one basket. You're like, I'm going to buy Boeing. Okay, so let's say Boeing is trading for $40 a share, and you buy 100 shares. Okay, how much you have to invest to buy 100 shares? $4,000. Okay, now this is the lesson of investing. If something bad happens to Boeing, and this is the only stock you own, this stock, these 100 shares, are only worth what somebody else is willing to pay you for them. So when news breaks about this problem with the MAX, and they ground all these planes, and you try and sell this stock, are you going to be able to sell it for $40? Probably not. So you tell your broker, because that's generally when you buy stock, you buy through a broker, okay, or a brokerage firm. You tell your broker, I want to sell my Boeing stock. You say, I'll sell it for as low as 35. So those are the people on the New York Stock Exchange, and they have more customers than just you understand? And there's a lot of people trying to sell Boeing stock today. And so they go down and say, I got 100 shares of Boeing, I'll sell for $39. Crickets, nobody's buying. $38. $35. Nobody's buying. Now you told your broker that's as low as you wanted to go, so you're stuck with the stock. He calls you, said I couldn't sell it. So you go, okay, I'll go as low as $30. Okay, so then the next day they're on the floor. I got Boeing stock for $33. Nobody. 30. Some guy says, yeah, I'll take that. Bam. Okay, so you sold this 100 shares for $30. How much money did you lose? Minus $1,000. Now, if there's some big scandal at Disney, something goes wrong, okay, then maybe their stock gets hurt. Now, there's something you can buy to make you more diverse, to create a portfolio that is diverse. Something you can buy. Does anybody know what that's called? You ever heard of a mutual fund? Okay, so mutual fund is going to buy stocks in a lot of different companies. Okay, so how much you need? About $2,000, $2,500 to buy a mutual fund. Okay, you need $2,000 to get into one. All right, now when you buy a mutual fund, and we'll just call this like a blue chip. You guys know that term, blue chip? So like when Duke is recruiting basketball players, Duke only recruits blue chips. You know, guys that are ranked high in the rankings of the athletes that year. Okay. Your blue chip stocks are your big American companies. Okay. So with this $2,000, you're going to buy 5% of your $2,000 is going to buy General Motors. 5% is going to buy Microsoft. 5% of your 2,000. Okay. McDonald's, 5%. Coca-Cola, 5%. Okay. And then Pfizer, 4%. Okay. IBM, 4%. General Electric, 4%. And Amazon, 3%. Okay, on down until you get 100%. Okay, so your $2,000 is invested in all these companies. Pfizer has a really good year because of the vaccine, right? They're making a lot of money right now. Okay, but McDonald's has a bad year. They balance each other out. Follow me? Now, your hope with mutual funds, and guys, there's all different kinds of funds you can buy, mutual funds. So my wife and I use Edward Jones. They're like on every street corner in Wichita. They're all over the place, okay? So what your goal is with mutual fund, guys, this is the stock market from 1934 to 2015, okay? Now, this dark blue is the market. This light blue is, hey, if you invest with Edward Jones, this is where you can pay instead of here. Okay, it's just a marketing ploy. Okay, but anyhow, if you look at over time, the stock market goes up between 6 and 12%. Okay, over time. 2019, guys, my accounts went up 21%. Now, how you doing in that savings account you got? What kind of interest you making on your savings account at the bank? You guys all have savings accounts? What kind of interest they paying you to borrow your money? You're not getting 2%. You're getting less than 1%. It's a joke. You understand? Your money is not working for you. Now, I know that money, you're 17, 18 years old, you need that money in the next year. I mean, you're saving that for college or expenses, stuff like that. Right? So I understand. You're just holding it there instead of under your mattress. Okay? But when you guys become able to, like when you graduate from college, 4.5 years from now, okay, you get that first good job, or 6 years from now, get your master's, you get that first good job, you need to start setting money aside. Okay? In a smart way. Okay, now, people play the market. This is legalized gambling. And what you're betting on is how well these businesses are going to do. Okay? It's legal to do this. All right? You are taking ownership in these companies. These are publicly traded companies. Okay? So these companies have billions of owners. Okay? Now, some people may own, 3% of McDonald's stock. Okay? As I said yesterday, Mark Zuckerberg owns 51% of Facebook stock. He has managing control. Okay? Most of these companies have a CEO and a board of directors that run these companies. Not the, Henry Ford's family no longer runs Ford Motor Company. You understand? It's run by a board of directors. Okay? And their job is to make money. For who? The investor. You understand? They have to turn a profit for the investors. Okay? Because they're invested in the companies too. All right? So, the government wants you to save money for when you retire. You guys know about Social Security, and they're saying it's going to run out by 2037. We don't have enough money. So they're going to raise taxes or do something to fix it. But either way, guys, you don't want to rely just on Social Security when you retire, right? Do you? You want to live on $18,000 a year? That's what the average recipient gets. $18,000 a year on Social Security. You don't want to live on that. So, a lot of you guys will find jobs that has a 401k. Okay? I have a 401k here at Bishop Carroll. So my 401k, after 23 years at Bishop Carroll, is worth about $130,000. Can I retire on that? I can't retire on $130,000. I'd have to keep working. You know what I mean? So now, by the time I do retire, hopefully that's more like $250,000 or $300,000. Okay, because the more I have in there, the faster it'll grow. The market goes up. You understand? Okay. So if you invest $1 and make 20%, you're not making very much money. But if you invest $100,000 and you make 20%, you're gonna make a lot of money. You understand? Okay. It's both time and the amount you put in. Okay. So if Boeing stock goes up, okay, to $50 a share, and I didn't sell, I make $1,000, right? So now my investment's at $5,000. I started $4,000. Now say I want to sell that and take my $1,000 profit. Guess what? It's going to be taxed. This is a capital gains tax. Today, that capital gains tax is 23.9%. So, 24%, $240 is going to go to the government. You get to keep the rest of the profit. Okay? Now, under a Biden administration, this number is supposed to go up. You don't know what the capital gains tax is going to be when you retire. It could be 39%. Who knows? So, this is what I want to teach you. So, the first time you go to invest your money, go to a broker and say, I want to invest some money for retirement. This is what you want to buy. It's a Roth individual retirement account, an IRA. Okay? Senator Roth, back in the 90s, helped create this. He sponsored this bill because he wanted to encourage Americans to invest for the future, their own future. And so when you get this money out, when you retire, you can start pulling money out of an IRA when you're 62. This is tax free. Okay, tax free. Josh, what are you going to major in? Cindy, you know what you're going to major in? Forensic science. So you're going to work for the FBI? Huh? Okay, well, you won't make a lot of money. You'll do okay. You know, there's probably you might be able to get 6 figures, okay, over time. What are you going to study? Okay, finance, accounting. I recommend those two. The others I don't recommend. Now, there's some specific ones that you can do, like more specialized. Finance is where the money's at. Accounting is where the jobs are. You're always going to need accountants. What are you going to major in? Veterinary? Be your own boss. Start your own veterinary clinic. That'd be great. You can make some money doing that. Right? You might be rich. Yeah. Okay. Make pretty good money doing that. Yep. Okay. Make a good living. You'll be working for somebody else. Okay. If you can work for yourself, that's where you make real money. You know what I mean? So, average Americans can put up to $6,500 a year in a Roth IRA. Okay? Now, that's a lot of money. If you're making $50,000 a year, you may not be able to put that much in each year. But you want to put at least $2,000 a year, maybe $3,000 a year if you can stretch it into your Roth IRA. Okay? If you start early, and I know this is hard for people to do, But if you start at 18, you invest $2,000 a year in mutual funds to the age of 29, $2,000. Okay? You turn 65, you will have $1 million. You stop putting $2,000 in at 20 after you're 29. Do this for 11 years, $2,000 a year. Because of all those years, that 50 years, this is going to grow. You understand? Or 45 years, this is going to grow. Okay? If you start investing at 29, okay, you're going to have to put in money every year until you retire. Does that make sense? So the compound interest factor here is huge. So the earlier you can start, the better. Okay? So like my wife's 401k is way bigger than mine. First, because she makes more money. And second, she started sooner than I did. Okay? So a 401k is like a Roth. Okay? So if you ever go to a job, they say we have a 401k, do it. Okay, so I take 6% of my paycheck every 2 weeks, and it goes into my 401k. Bishop Carroll, the diocese, matches that, gives me an extra 5%. This is in addition to my salary. You understand? This is free money. So do the 401k. Yes, is your paycheck going to be 6% less than you would if you didn't do a 401k? Yes. Okay, but this is free money you're getting in addition. Okay, now most big companies used to do what were called pensions. Okay, so Cindy, if you work for the FBI, you'll get a pension. So if you work for the FBI for 30 years and then you retire, you'll get a partial check for your salary, usually about 60% of what you make your last year as an FBI agent. You'll get that for the rest of your life. If you're a school teacher in the state of Kansas, you teach for 35 years, retire, you'll get a check for the rest of your life. Governments have pensions. They're broke. They don't have enough money. They're broke. Guys, we have hundreds of billions of dollars in unfunded pension liability in our states. It's bad. You ever hear how like Detroit went bankrupt? They went bankrupt because they couldn't pay the retirees. You know, the city bus driver that retired, the firefighter that retired, they couldn't pay their pensions. So most companies don't have pensions anymore. Some do. And if you find a company that's got a pension, go. Because they probably have a 401k too, where my wife works at Coke, and I don't know if they do this for all Coke employees, but my wife has a pension and a 401k. But when she retires and hits 62, she can start taking money from both those and take Social Security. You understand? So our plan is, when we retire, we're going to be fairly wealthy. Now, my wife makes too much money. She cannot put any money in a Roth IRA anymore. She makes too much money. And once you hit a certain income, now I can fully fund mine, $6,500. Okay, which I haven't been doing, but I should be. Okay, so if you have these two things, so take it out of your check for your 401k, take it out of your check, put it in your Roth IRA each pay period, and then guys, when you're 21, 22, 23, and you start doing that, guys, by the time you hit 50, you're going to be looking at retirement accounts with a lot of money in them. You're going to be feeling secure about your life in your old age. I mean, you're like, this feels pretty good. Now, could the stock market crash and the value of my Roth and my 401k take a big hit? Yes. Now, if that happened to me when I was 40 and the stock market took a huge dive, like it did after 9/11, for the next 7 years, as it's going back up to where it was before 9/11, I'm buying stocks at a reduced price because the market went down. Follow me? So downturns in the market when you're young, you can absorb a heck of a lot more risk than somebody that's at 60 years old. So I'm about close to 10 years away from that, right? My wife and I met with our financial advisor last month. We did not change our risk assessment. Still aggressive, not super aggressive, but aggressive. Buy stocks, buy stocks, buy stocks. Okay? Take your dividends, roll them back over and buy more stocks. Okay? Because we still got a while till we retire. We're still going to be aggressive. Okay? When you get 60 or 55, you start to move some of that money out of the stock market and you move it into bonds. Bonds have less risk, lower returns. Okay? But they're safer. There's other places you can put your money. For a short term, you can do like a 6 month, 1 year CD or certificate of deposit. There's money markets. Okay? There's a savings account that you guys can use called ING. Okay? It's kind of like a money market, but it's a savings account you can withdraw money from. I get like 1.9% interest on it. It's a good place to hold cash. You know, you got like an emergency fund. Okay? There's lots of places to put your money to work for you. But guys, there's days when the stock market goes up that I make more money in a day in the stock market than I do in 2 months teaching. You know what I mean? And I don't have to get out of bed for that. Okay? So you can be afraid of the stock market, but you shouldn't be. Especially when you're young. Okay? It will pay dividends for you guys. But guys, this is tax-free. Roth IRAs are tax-free. When you get that money out, you pay no capital gains tax. Zero. It's the best deal in town. Okay? That's why if you go to an Edward Jones and you say, I want to invest some money for the future, they're going to say, okay, let's set you up a Roth IRA. Does that make sense? Okay? Yeah.
So the stock market, say you're like 60, the stock market big crash and you have your Roth IRA, could you like lose money? Like
you can move it out without paying taxes. If you sell it, you got to pay the tax. Well, okay, before 62.
Yeah.
Can you take your money out if there's stock market crash?
Yeah.
With penalties? Yes. Now, can I move my Roth IRA into bonds? Yes. Without paying penalties. Still invested. If you sell, okay, like get out, that's when you pay the capital gain. Okay. Or the penalties, because there's no capital gains for this. But if you take money out early of an IRA or a 401k, you pay penalties. Okay, you can't touch either one of these till you're 62. Okay, there's traditional IRAs as well, which my wife and I have some of those. You do pay capital gains taxes. Okay. So this is where it's at. Okay. And if you work for the government, guys, you get a pension. And it's hard to get fired. If you're a teacher, it's really hard to get fired. And you have to be sitting at your desk smoking cocaine. Although you might not even get fired for that. Because it's a disease. So you go into treatment and they still pay. Now, if you have a relationship with a student that you should not be having, that'll get you fired. And you go to jail for that. And if you're in jail, you can't teach. So, but really, guys, think about it. It's about the only thing that's really going to get you fired as a teacher. You work in 259, and say you work at Northwest High School, and you're a horrible teacher. The principal's going to move you. They're going to send you to a different school in 259. And then that principal's going to have to deal with you. And then if they don't like it, they're going to move you to a different school. I will not teach in the public school. I will not. Right. All right. So, just give you a pretty good understanding of the market, okay? Now, how can the market just like crash? Okay, what went wrong? Okay, so I gave you a couple indicators earlier about tariffs clogging trade. So when we started putting tariffs on European goods and Canadian goods, they couldn't afford to sell stuff. They weren't selling stuff here, so they didn't have money to buy our stuff. And then they retaliated with their own tariffs. And so we were having a hard time selling goods over there, which meant there's a slowdown in production. When there's a slowdown in production, people lose their jobs. And that means there's fewer people that have money to buy American goods. Okay? And then one of the last line I had in the last notes was production rose 40% over 10 years, where wages rose 26%. People were not making enough money to buy all the products that were being produced. We saw indicators of that as early as 1927, a slowdown or a contraction of the economy. The economy is either growing or it's contracting. Okay, and by 27 we were contracting, but the stock market kept going up because people were trying to get rich in the stock market, not looking at those companies I had up here and whether they had any type of growth perspectives. Okay, if our economy shrinks, guys, the stock market's going to go down. Does that make sense? Now, there are certain things that the government does to make the stock market go up. And the biggest thing that the government does to make the stock market go up is lower interest rates. When people want to borrow money, when big businesses want to borrow money, if the interest rates are low, that means it's cheap money, people are going to borrow it. Okay? So, like, if I can get a mortgage for 3%, a mortgage for a home for 3%, okay, that's cheap money. All right? If I could borrow money at 3%, let's say I borrow $100,000 at 3%, and I invest that in the stock market, and I make 6% return on that. I'm making money off of somebody else's money. It's dangerous to do that, because that's what was going on during this time period. They're called margin loans. People were borrowing money to invest in the stock market. This is like me borrowing money to go to the dog track. I go down to Intrust Bank and I say, hey, I'm going to the dog track tonight. I know the number 6 dog in the number 8 race is a for sure winner, but I only have $100. Can I borrow $900 from you today so I can put $1,000 down? I'll come back tomorrow and pay your $900 back with interest. Is Intrust Bank going to give me money? No. But they were giving people money in 1927, 28, 29, borrowing money to invest in the stock market. And they were giving margins of like, you put down 20%, borrow 80%. It's crazy. And when the market went down, the investor loses their initial $200, and then they owe the bank $800. Are they going to be able to pay the bank back? Oh, no. Now the banks are in trouble. Okay? So, in October, guys, October is traditionally a rough month for the stock market. Okay? October 29, of course, but October 1987, it's a really big drop. If you look at these drops in the market historically, you see quite a few in October. Okay? But if you go here to 2001, 9/11, okay, you see a big drop here. Okay? October of 87, come back here, big drop right there. Okay? And then 2009, housing bubble, big drop. Okay? So that ended up being pretty good for me as an investor because it dropped that much. I was buying new stocks at a cheaper price. You know what I mean? And now it's back up. Okay, so downturns are okay. They're cyclical. And in the end, timed right, it really works out well. Okay. So it's October. The market is way overpriced. Okay. On the 24th, prices began to fall, and panic setting. So people were trying to sell their stock for a big profit. Nobody was buying. Remember, your stock's only worth what somebody else is willing to pay you for. So nobody was buying. So the bankers started freaking out. This is J.P. Morgan. Him and a bunch of other bankers got together on the morning of the 24th and said, we need to do something. They pulled together $240 million and started buying up stock. So if you were one of those people trying to sell stock, you're like, I can't sell my stock, I can't sell my stock. And then all of a sudden, boom, somebody bought it. So confidence was temporarily restored and the market rebounded that day, came back up, okay? Monday, things were not much better, started a pretty big sell-off, and then Tuesday, guys, well, Hoover goes on the radio over the weekend and tells the American people, so don't panic. Everything's okay. The economy's on solid ground. What do people do when you tell them not to panic? They panic. And on Tuesday, which is Black Tuesday, the bottom started to fall off. Now, guys, the stock market didn't go from 900 to 0. We say crash, not a complete collapse. Now, today, guys, we have contingencies in place. If the market drops below a certain percentage, they close the markets. Okay. That's happened a couple of times, like in 2009. That happened a couple of times. Okay. But then you open up the next day and it's going to drop again. You know what I mean? 16.5 million shares traded in one day. This is called a ticker tape machine right here. Okay. This is, if you ever watch Sports Center, you see the scores coming across the bottom. They call that a ticker. This used to be in the newspaper every day. You could look at stock quotes in the newspaper every day. The Eagle doesn't even carry these anymore, okay? Because the Eagle sucks. All right, but because they go to press at like 6 o'clock the night before, so anything that happens after 6 o'clock is not in the newspaper. They print it in Kansas City. The Wichita Eagles print it in Kansas City. And they have to ship it down there. Now they're moving that printing to Hutch, but they still said their deadline's not going to change. Right. Okay. Whatever. All right. I'm still paying for that rag. It's horrible. Okay. Anyhow. So if you go by CNBC or Fox Business News on the TV, you'll see the ticker running across. Gives you the stock quotes. Okay. This is what they kept track with back in 1929 is this machine. You would type it in and it would print this paper out. Okay. With it, by 11 o'clock that morning, guys, they were already behind on this. They couldn't keep up with all the trades. Okay. This is how you get a ticker tape parade. At the end of the day, all this paper that comes out of these machines is worthless. So they use it as confetti for parade. They throw it out the window. That's why they call those parades in New York City ticker tape parade. Okay? You learned something new today? Okay. So hopefully a lot. All right. Now, so if you look at the price of the top 50 companies, those blue chip stocks, they fell to the average about 50% that day. So like any money you made the previous year in the market was gone. Okay. And so it goes up, it goes down, it goes up and down. And I'll show you. This graph right here. Okay. So remember, the economic indicators were showing as early as 1927. Over here. In 1927, the economy was starting to shrink. But look at the stock market. And really, when you hit 1928, 29, guys, look at it. It's going straight up. And then boom, again, you're straight up. People are trying to get rich quick on an economy that is shrinking instead of growing. This is a bad recipe. Okay? So this is Black Thursday. And then, the bankers come in, bought up all that stock, it rebounds a little bit, and then this is Tuesday. Okay, so the market will come back up, down, up, down, up, down, up, down. It's rock bottom about mid-1932. Okay? So when you think crash, the stock market crash, you're thinking from here to zero, right? That's not what happened. Okay? It took time. But by 1932, let me give you some examples. General Motors was trading at a peak of $84 a share in 1929, September of 29. By 1932, it dropped to $8 a share, 84 to 8. Montgomery Ward, you ever heard of that? You heard of Sears? Montgomery Ward was the first Sears, or J.C. Penney, okay? They went out of business about 10 years ago. All right, that's probably why you hadn't heard of it. Okay, now, they were at $104 a share, okay, per share. Dropped to $4 a share in 1930. Okay, so did this affect the average American? Was the average American investing in the New York Stock Exchange? No. Okay. My grandfather, in 1929, was a welder in Columbus, Ohio. He did not own any stock. Okay. My dad was born October 21st, 1929. My dad. Okay. Just 8 days before the crash. Now, it would affect his family eventually. It's going to affect everybody. Okay. But if you didn't own stock, it wasn't going to affect you immediately. But it would trickle down to you. Okay. Because of the depression. Okay. And this is one of the causes of the depression. Not the stock market itself. It's this investing in something that is not growth. The gambling. Speculation. Okay. Now, this is kind of funny. This is kind of the psychology of an investor. So you take your first $2,000 and you put it in the stock market, okay? And you're like, I'm optimistic, I'm going to make some money. It starts to go up. You're excited. All right, it's working. I'm thrilled. And then it goes up and you're like, man, I'm a pretty smart investor. I know what I'm doing, right? And then it starts to go down. You're like, I'm a little worried about it. No big deal. And then you're like, really? This isn't happening. Denial, fear, desperation, panic. Then you give into it, capitulate. You're despondent. Then it starts to creep back up. Okay? You're still desperate, but then there's hope of getting back to at least where you started. Then relief. Oh. And then, hey, we're on the upswing. Let's go. Okay? This is why I don't watch the market every day. Okay, it would drive me crazy to watch the market every day. This is my life savings. Almost all of my life savings are tied up in the stock market. And if I watched that every day, it would bother me. So I meet with my financial guy twice a year, every 6 months. Okay? And then I generally ignore it. There's nothing I can do about it. Okay? Now, you have people that trade that are day traders and stuff like that pay really close attention, and that's fine. You got to be good at it, though. It's like gambling. Some people are good at gambling. Most are not. How do you think the casinos make so much money? Off of bad gambling. Okay? So, this is the scene outside the New York Stock Exchange on October 29th. Everybody on pins and needles waiting to hear the latest news about what's going on inside. It was a crazy day for the United States, October 29th, 1929. Okay. And had a little video. Okay. Hope you enjoyed the 1920s theme music today. Okay. Now, you guys got to watch the video in class. Did that go okay? Home and get it figured out and everything? I'll bring in some 30s in the next decade. Oh. Yeah, absolutely.
And I don't know how that's gonna work at all.
This is a pretty good recap. What I talked about, plus a little extra.
As the Roaring Twenties were drawing to an end, so too was an era of relative prosperity for many Americans. As early as 1926, the construction of new housing had decreased. Businesses had too much inventory and too few buyers. Nevertheless, an optimistic America wanted to believe that the good times would last forever, pointing to fortunes that were being made on the stock market. Even people with little money to spare wanted in on the action, and stockbrokers readily agreed to sell shares on margin, where they would lend citizens money to buy stock. These investors figured the stock's price was bound to go up and up, allowing them to pay back the stock's original price tenfold. The constantly rising price of stocks cast a spell over the nation. Noon-hour traffic stood still as people eagerly awaited news of their improved finances. Even distinguished Yale University economist Irving Fisher made a bold speculation.
The nation is marching along a permanently high plateau of prosperity.
But the simple fact was that the price paid for many stocks was unduly out of proportion to the actual profitability of the companies who issued them, creating the illusion of increased value. On October 29, 1929, reality finally caught up with the stock market, and what went up came crashing back down. Panicked investors sold 16 million shares in a single day, many for just pennies a share. Millions of other stocks went unsold entirely on that afternoon, known as Black Tuesday. In just a matter of hours, the stock prices took such a nosedive that any gains made over the previous year vanished. The market's collapse was the most distressing downturn in the history of the New York Stock Exchange. So distressing, in fact, a number of investors committed suicide rather than face financial ruin.
So they mentioned the margin loans there. You need to know that for the test. That's where people borrowed money on margin. So the margin, like I said, was at times as low as you put down 20%, borrow 80%, okay, which is just nuts. And this is really going to affect the banks as we move into the depression. You guys, on next slides, as we go through this, you're going to see banks going under. Actually, when it's all said and done, more than a quarter of all the country's banks will go under. Okay, so this is a Great Depression. And then the other thing, they're right at the end, they mentioned the suicides, right? Guys, there's a little bit of a myth here, okay? So if you look at the statistics of suicides prior to the stock market crash, after the stock, there's no like huge uptick. Sometimes they portray this as like people were hurling themselves off of buildings and bridges in New York because of what happened here. That was not the case, okay? There were some people that committed suicide, but it wasn't like a crazy number. As time went on, it would be very distressing for people. When the banks shut, we'll talk about this. You know, I mean, people would lose their life savings that were in the banks. There was no protection for your money. Okay, so it's a tragic tale, but at the same time, a lot of Americans continue to do okay, you know, or fine. Even some people do well. Now, if you got out of the market before it crashed, you made a lot of money. And one of the people that did that was a guy named Joe Kennedy. He was the patriarch of the Kennedy clan. He was the first Kennedy that kind of came in from Ireland, and he's the father of JFK and Ted Kennedy and the Kennedy clan. He did very well in Prohibition and the stock market. Okay, so the Kennedys became a very wealthy family. So that's an interesting study, and if you need a book to read about, you can read about the Kennedy claim. Right? So that'll wrap up today. Tomorrow, what am I getting into? We're going to sink into the depression. Okay. Yeah. So we'll look at some of the causes in a little bit more depth, and then talk about Hoover's reaction to it, and sometimes lack of reaction. Okay, Hoover's going to get blamed for a lot of this. Thanks, and so forth. Okay, I know this is not the most exciting topic in the world, and quite depressing at times. Okay, so I'll do my best to make it interesting. Okay, all right.